Hello and welcome. I'm Whitney Roseborough, one of the marketing coordinators here at Squire. Thanks for joining us today for our 2021 market review. To get started, I'd like to point out the Q&A section in the top right corner of your screen. Throughout the presentation, feel free to post any questions you may have, and the presenters can answer them and at the end. Now let me introduce you to our presenters today. Today you will be hearing from Clayton Johnson and Nathan Larson. Clayton is a certified financial planner professional at Squire and Wealth Advisor for Squire Wealth Advisors. He works with business owners and clients preparing for retirement. And Nathan is a CPA and wealth advisor for Squire Wealth. His focus is financial planning and tax. He enjoys helping his clients with all areas of finance and tax strategies. So with that, take it away, Clayton.
Thanks, Whitney. We're excited to have you guys here today and talk to you a little about what's happened in the last year and talk more as well about what we can expect and how we should approach our investing in our portfolios, given all the crazy things that have been going on. Nathan, if you wouldn't mind going to the next slide. So, and then the next one. So we're going to start off by just talking about what's happened in 2021 in the markets, going over the U.S. and international asset classes and how they performed. And then we'll talk more into commodities and fixed income, and then get into the benefits of diversification in our portfolios, what investments look like actually during times of crises, and then given the recent highs we've had in S&P 500 and various other indices, what we can expect based on history in these type of scenarios. And then we'll talk about inflation and follow up with Q&A, and you can ask questions that you have about concerns in the market or just other general investing questions. So Nathan, I'll pass it on to you.
Okay, welcome everyone. What a crazy year we had in 2021. We're now year 2 into the pandemic, and we've experienced all kinds of ups and downs, both in the markets and in life in general. But we wanted to have a little bit of a recap of what happened in the markets in 2021. So here we've got kind of some broad asset categories. The U.S. market performed really well in 2021. It was the top performing market. As far as stocks go, it was up over 25%. You can see the international market was still up in the developed market, above its average, but not as high as, didn't perform as well as the U.S. And then the emerging stock market was actually down last year. So far this year, things have been kind of up and down. The international market and the emerging markets have actually been the top performers. So kind of interesting to see that flip. Of course, we don't know from, in the short term what's going to happen with each of these markets, but over time, we would expect that the international market will catch up. You can see down below, since 2001, emerging markets have actually been the top performer. The U.S. market's performed right at its average. The international developed market's been performing below its average over the past 20 years. So, and you can also see the best year and worst year for each of these. And you can see we don't want to rule out emerging markets just because it kind of had a bad year last year. You can see in 2009, it had its best year and it was up over 78%. As far as the top performing asset class, it was actually global real estate, which is good to see. It had a over 30% return last year. And interestingly enough, the fixed income markets or the bond markets, those actually had negative years as well in 2021. And the reason for that, we had some interest rate changes. So we were, when the pandemic first hit, Federal Reserve lowered interest rates as low as possible, basically to zero. I mean, I guess you can go negative like we've seen in Europe before, but we were at zero. And then as the economy started to recover from that initial drop due to COVID, we saw interest rates slowly rise. And when interest rates rise, bond values go down because you can buy a new bond at a higher rate, and so your bonds that were issued at lower rates go down in value. The interesting thing going forward in 2022 is, again, we don't know what's going to happen, but the Federal Reserve has indicated that it will likely raise interest rates a few times this coming year. So we'll see what happens there. The stock market doesn't always love that, but in general, that means that the economy is growing, and changing interest rates or raising interest rates is one of the Federal Reserve's way to kind of not slow the growth, but kind of cool down an overheating economy. So that's what happened in 2021 in broad categories. One thing this is one of my favorite charts here, which just reiterates the principle that discipline is rewarded for investors in the markets. And this shows you the growth of a dollar in the world stock index back from 1970 to 2020. And if we were to add 2021, it would be positive growth as well. But you can see some of these various headlines that have happened. The news and the media like to sell what's, the scary stuff and kind of the big headline things, but the stock market does its thing. And the reason it does its thing is because when you invest in the stock market, you're investing in businesses. You become an owner in several businesses, and those businesses are out in the marketplace trying to turn profits. They're selling products and services that to turn profits, and you share in those profits when they happen. And collectively, the stock market figures it out, and those businesses figure it out, and investors are rewarded for staying disciplined. So we don't ever want to be changing our investment approach or our portfolio or trying to time different things, because we don't always know how the market's going to react to particular headlines. And you can see that from this chart, that sometimes the headlines are the market goes down after, but sometimes it goes up, and the disciplined approach and what has rewarded investors over time is just sticking with it. And we saw that during the pandemic as well. There would have been lots of times to sort of panic with the uncertainty of the market and how it would react to different things going on in the world, and that would have been a bad approach, because we saw the reward for being disciplined and sticking with it. If we drill down a little bit into the U.S. stock market, we can kind of see exactly how that growth happened and what took place there. So our top performing asset class within the U.S. market was actually the small value stocks. And that's good to see, because that's what we'd expect. The small value stocks, those are stocks that have a premium because they're smaller companies and they're value companies. There's a risk premium associated with those. And over time, we expect that to be our top performing asset class. It doesn't always happen every single year, but over a long period of time, small cap value stocks have been the top performer. Large growth, the next one there, actually has been way outperforming its average for the past few years. And we saw that again. It was their second performer. And then if you go down, you notice that the large value did not perform as well as large growth, which is kind of flipped with what we would expect. But that can happen on the short term. In the long term, we'd expect large value to outperform large growth. So pretty interesting. The takeaway here is we did see the small value premium show up. It's been kind of missing for the past few years as the large growth companies have way outperformed their averages. And it was nice to see that small cap value premium come back.
Hey, Nathan, one thing I wanted to add there, we're very much advocates of the small value premium. If you're a client of ours, you know that we try to tilt portfolios in this general direction. And that premium that Nathan was mentioning is pretty substantial. So if you go back to July of 1926, the value premium, so the value versus growth, is a 2.66% difference. So that's on average annually since 1926. So we would expect the small value premium to be pretty substantial in a portfolio where we noticed that difference. But the thing, and Nathan touched on this as well, we've had a fairly large period of time where growth has outperformed value. And the thing about the value premium is it shows up oftentimes in very short bursts. It'll come really quickly and in a large magnitude. So we saw that at the end of 2020 and the beginning of 2021, value stocks really did well, and they made up for a lot of that missing growth that they were having over the prior years, which just illustrates the need to be a patient long-term investor, especially when you invest this way, because it's really hard to look for a few years and say, hey, my value stocks are not doing like I'm expecting. But when you take the long-term perspective and you wait patiently and you are a little more meticulous and processed in your investing, those premiums show up and you see that benefit over the long run.
Yes, thanks for that, Clayton. I think our next slide kind of shows what Clayton was just talking about. It has the premiums above the 1-month treasury bill rate. So the market premium, that 8.7%, that's what historically we would expect to earn above the treasury rate for investing in stocks in the general market, if you were to just buy the market as it is. And then there's a size premium, that's the small versus large company premium, an additional 3% above the three small stocks have outperformed large stocks just by 3% per year. And then the value premium, that's the value above growth. The two on the right there, those are the fixed income premiums or the bond premiums. There's really only, with bonds, to get a higher yield or a higher interest rate, we can extend the term. And by extending the term, that means instead of a 2-year bond, you buy a 5-year bond or maybe even a 10-year bond. And that will get you a higher interest rate, but you're taking on more interest rate risk, because in general, if the Federal Reserve lowers interest rates, then you do okay. But if they raise interest rates, then the value of your bonds go down. And then you can take additional risk with credit. You can invest in lower credit quality bonds, which means they're higher risk, and you can tend to get yield, but there's not much there. Less than 1% premium for investing in riskier bonds. This chart's kind of fun. It shows country returns. With the really strong performance of the U.S. market, it kind of makes you think or raises the question of why are we investing in the international market at all? And here kind of shows the general market returns by country. The U.S. was 8th. The blue line there is a global diversified portfolio. But the idea here is we don't know which country is going to be the top performer from year to year. And there are really good investable companies outside of the U.S. And so we want to capture some of that growth internationally. And so we diversify. We invest in both the U.S. and the international markets. And we don't worry about trying to pick which country is going to be the top performer. We invest in all. And by doing that, you kind of remove the risk that you're going to be the losing countries, which last year it was Turkey, China, Peru, Chile, Brazil. And you kind of get more towards that middle, which is what the benefit of diversifying is. If we had a crystal ball and we were able to pick, then of course I would have said, let's load up on Czech Republic. Everyone would have thought I was crazy, and you would have had a good return. But since I don't have a crystal ball, we recommend diversifying across the global market.
Yeah, and Nathan, one thing I want to add here as well, the global market, the U.S. typically constitutes around 60% of the overall global market when it comes to the value of stocks. And so there's 40% of the market that's represented by these other countries. And there's a lot of really interesting research around our behavioral biases as investors. Regardless of what country we're in, we tend to have a home bias. So if I'm from Sweden, if I'm making my own portfolio, I'm going to tend to make my portfolio more focused on Swedish companies. And that's pretty pervasive across what country you come from. We tend to have a home bias. And so it's important, I think, in application here, to recognize that many countries have great returns in the companies that are headquartered in their countries. And we need to sometimes turn off that bias, or at least recognize that we have a home bias and try to have a more global portfolio. So when we're building a portfolio, having 60% or so representative of the U.S. and then try to get some more international that represents about 40% or so in a portfolio. And so I think it's important to recognize those our own behavioral biases when it comes to home bias and how we invest.
Yeah, and that's a great point. Another way to look at this is because the U.S. has had such strong performance recently, the international market is kind of due to catch up. We can't time that. Again, this is kind of an issue that's been happening over the past few years. So if we would have said, hey, the international market's due this year, let's load up on international, we would have missed some of that growth that was in the U.S. market. And again, because we don't know on the short term what's going to happen, we just want to get a well-diversified portfolio, which, as Clayton mentioned, typically we're 60% U.S. market and 40% everyone else. And that ratio comes just by the investable country breakdown of the world. So we're just globally diversifying, and that's generally the best approach. If you go back to there was a period of time not that long ago, about 20 years ago, when we had the lost decade, and the lost decade was where those U.S. large growth companies, the S&P 500 companies that have been on a tear recently, there was a 10-year period where the return was basically zero over that 10 years. And during that time, the international market had really strong performance. So if you would have been only in the U.S. market, you'd have lost a decade of returns. But having a globally diversified approach, you still did okay because the international market kept up the total return that you would have experienced. All right, commodities is always fun. I know everybody's filling up their gas tanks and they realize they're paying, 3 times as much as we were a few years back. But commodities tend to be a good diversifier in a portfolio. They add a little bit of a hedge to inflation, but it's always kind of fun to look at how the commodities market did. Of course, gas and oil had a really strong year. Demand was very down, was down significantly when COVID first hit. And then as the economy started opening back up and people started traveling and driving more and using more oil, the oil prices and things came back very strong. And then just for fun, it shows a few of the other commodities. Silver and gold, notice those were actually negative last year. And just a couple other fun ones. Zinc, which if you're taking zinc supplements to boost your immune system, was kind of the middle of the pack. But some of these, remember, like the gold and silver and precious metals and different things like that, they're a little bit different of an investment, because if you think about the stock market, you're investing in companies that have a revenue generating activity. They're selling goods and services. Gold, silver, even you could throw in cryptocurrencies, all those things. It's purely speculation trading, and there's not really a revenue producing aspect. If you buy gold, it's just a metal. It's not going to be generating more gold. The only way to really have some growth on that is if the price goes up and you sell it at a higher price. So kind of a different approach. But these commodities, we can add in a small allocation if people want more diversification and as sort of a little bit of a hedge against inflation. All right. The last thing I want to talk about before I let Clayton show you some cool slides is fixed income rates. And these are the interest rates. We've talked a little bit about these. Generally, we had rates go up in 2021, not by much, but for example, the 10-year U.S. Treasury, at the end of the year, it was 1.52%. I think at the beginning of the year, it was like basically a quarter or so, maybe a little more than a quarter. Now, the rates have actually come up this year already because of the Federal Reserve's expected rate increases. I think a 10-year Treasury is almost to 2% by now. But pretty interesting. The best performing fixed income investment in 2021 was inflation protected securities, or TIPS. And what those are U.S. Treasuries that are guaranteed to pay at least the inflation rate. And because we had higher inflation in 2021, those TIPS investments performed well. And those are a good hedge against inflation, only if inflation's higher than expected. So pretty interesting. We've got some challenges ahead of us as a country with government debt and interest rates and inflation. Like I said, the Federal Reserve's already announced that they'll likely raise rates this year, which now how the market reacts will just be a matter of, do they raise it more than the market expects, or less, or right on par? And we'll have to just, kind of see how that plays out. But now I'm going to turn the time over to Clayton, and he's going to talk a little bit about diversification and some cool historical data on how this market recovers after all-time highs and after crises.
Thanks, Nathan. I love that we use adjectives like cool and exciting when we talk about some of these slides. I think Nathan and I nerd out about this stuff more than most of you. So, but we do think this is really cool. It's some cool data to see. What we're looking at here is the impact of diversification in a portfolio. In this chart, you see various lines, this dark blue on the top, and then you've got the dark green on the bottom, representing different allocations to stocks and bonds. So that dark blue is 100% stock portfolio. That dark green is 100% bond portfolio. Going back to 1985 up to 2021, and you see how the more exposure you have to stocks in your portfolio, the higher your expected return. And in this scenario, a fairly significant difference of $58,000 portfolio versus a $6,000 portfolio that's just 100% fixed income. And a question that I get a lot from prospective clients and clients alike is they'll come to me and they'll say, hey, I want growth, but I want it to be fairly safe. And that's nigh impossible in this market. If we want growth, the price for growth is adding risk to a portfolio. And that's typically by adding stocks. When you have more stocks in a portfolio, there's going to be more fluctuations in the portfolio. As you can see, in 2008, there was a significant drop in that 100% stock portfolio relative to almost no change in the 100% fixed income portfolio, the bond portfolio. And so it's important to recognize, as you're looking at your own investments, what kind of risk are you willing to stomach? If you're on the leading edge of you want to get as much growth as possible and you're okay with taking as much risk as possible, then likely 100% equity portfolio is going to be best for you. You can stomach those drops and you can hang on. And when you do, the data and the research shows that over the long run, your portfolio is going to have a higher expected return. You can see here at the top, the 100% equity portfolio, the 10-year annualized return is about 12.7% relative or compared to a 1% annualized growth in a 100% fixed income portfolio. So there's a big swing there. So recognizing your own risk and what you can stomach and finding that ideal. And so there's no one size fits all type of portfolio for a client. That's really an important aspect to consider, is how much risk are you willing to take? And if you're willing to be risky and you can hold on and you've got a long time period to stay invested, you're going to be better off getting a more risky portfolio and a higher allocation to stocks. Nathan, can you go on ahead to the next one?
Yeah, just real quick, that risk is an interesting word. We use that to describe the volatility or the ups and downs of a portfolio investment. And the more that I've thought about this and studied it and worked with clients, it's not really the best word to describe it. What we really need to use is volatility, and then match up the timing of when we invest versus when we want to use the money. And then that gives us kind of an idea on how much risk or volatility we can handle. And so, because if you think about it, if you were all bonds and you stayed all bonds forever, you're really having a low chance. You're taking on risk in a different way. Your purchasing power of future dollars is going to be eaten away by inflation. And the volatility, we say you need to be riskier, but all we mean is let's invest in stocks where you have a chance for growth. And as long as your time frame matches up with the use of the money, then you have the ability to take that risk. So it's an interesting word, and I don't like it. I think there's a better way to describe what's really happening there. And again, it comes down to what's your ability, what's your willingness, and what's your need. And we can tailor your portfolio to match up that with your specific situation and circumstances.
Yeah, that's great insight. Thanks, Nathan. So in this chart, you can see it's identifying various crises that have happened starting in the 1987 stock market crash. We've got 1989, 1998, the dot-com crash in 2000, and identifying a number of fairly significant events that happen in history. And then showing us, here's how a portfolio that is 60% stocks and 40% bonds performed 1, 3, and 5 years after that event. So our tendency when something big happens is to say, oh no, things are going bad, we need to pull our money out. We want it to be safe, right? That is recency bias. That's something that we often go to when scary things happen. But I really like this chart because it shows that the patient, disciplined investor is rewarded. In all of these situations, within 5 years of these crises happening, there was significant cumulative growth in a 60-40 portfolio. And it shows the power of the markets and the ability of the market to recover. And really the market is optimism. And we believe at any given time that the market is going to grow. That's why we invest. We have this optimistic view that we believe that businesses are going to continue to succeed and innovate and grow. And you can see here that the data supports this idea that if you can hold on and be patient, you'll be rewarded. It rewards the long-term investor. And we tend to have this when a negative event happens, we're tempted to flee. But if we can hold on, maybe this chart, you pull this chart up when you're scared, it'll help you see that this is a long-term game, and we're playing for the long term, and you're benefited by doing so. Can you go to the next slide, Nathan?
Yeah, one more thing to add there is the timing game really doesn't work because you've got to know when to get out, and then you have to know when to get back in. A lot of the growth that happens, especially during recoveries, happens really, really quick. So if you pulled out and then tried to get back in, there's a super high probability that you would miss some of those really strong days or weeks when it has its strongest recovery points. And so again, the prudent approach is just to stick with it. It's probably do your work up front, figure out what your risk tolerance is, and that's our job. We work with you on that. And then you can ride out any potential crises that are going to happen.
Thanks, Nathan. So now this is the flip of that, right? We were just talking about when bad things happen and the markets take a dip and what happens. Now we're saying, here's what markets look like forward looking when you've hit all-time highs. Now in 2021, we had 75 all-time highs in the S&P 500. The market was doing incredibly well. And a question we get from clients and potential clients is, I don't know if I want to get my money in right now because the market's at an all-time high. I think it's going to drop. I think something's going to come down. So I'm going to hold my money on the side and wait till that happens so I can buy low. But the data doesn't really support that idea. In fact, a market high is not a good gauge for how the market is going to perform into the future. As you can see in this chart, from 1926 to 2020, if you look at the S&P 500, which is the 500 largest companies in the U.S. by market value of their stock, you're seeing that after a market high, on average, looking ahead 1 year, the market return of the S&P 500 is 13.9%. Looking ahead 3 years, it's 10.5%, and looking ahead 5 years, it's 9.9%. Now, this is on average looking back at history, but we can take this information and say, okay, it's not guaranteed that when the market is really high, that we're going to have a market drop soon. And I think that's an important thing to recognize. Really, the question we get a lot, when's the best time to invest? The answer is right now. There's no way to look at the current situation in the market and say, we know what's going to happen in a year from now. And so hold that money in cash so that when the market drops, we can throw it in and you can make a bunch of money. There's just no way. We don't have a crystal ball, and it's fuzzy, and no one does. No one has this crystal ball to predict what's going to happen. Even if they say they do, the data suggests the best time to be invested is now.
Yeah, and just to add to that, if you can remember back to your statistics class, I'm kind of a probability nerd and like to think about statistics. The market every year, 70% of the time it's positive. 30% of the time it's negative. That's pretty good odds on a 1 year basis. Long term, the positive percentage is way higher, but in a 1 year period, 70% of the time it goes up, 30% it goes down. I think I would take my chances at a 70% odds that it's going to go up. And notice here also on the 5 year look ahead, we get right back to where the average of the S&P 500 has been, which is 10%. In its lifetime. So the averages play out, and the trick is just to remove the emotions and have a good thought out plan and stick with it.
Yeah, absolutely. And because we expect stock markets to be up over the next 20 years, we expect on average that any given year or month or day, the markets to have a positive return. That is the hope, the optimism that we as investors, the billions of investors that are putting their money in there, is that expectation that markets are going to go up over time. Okay, so inflation's been crazy. If you look at the 1 year rolling inflation, it got up to 7% just a little while ago. Haven't seen this type of inflation since the 80s. Like 1982 was the last time we saw inflation this high. And so naturally it's a concern that we all have. We're seeing our grocery bills go up. We're seeing gas go up. We're seeing most of our expenses going up right now at very unusually high rates. And so a question we get a lot is, I'm concerned about inflation. So what can we do in our portfolio to combat that inflation? And the short answer is stocks. Stocks are a really great way to hedge against inflation. You can see here in this chart, the little pink dots with the line show what inflation is like going back to 1991, how the inflation rate changes each year. That's the rolling 1 year inflation rate. And then the bluish green bar is what the S&P 500 returned over that year. And so you can see, and this is what the point we're getting at is, there's not really a correlation or even a really good gauge of inflation is this amount, so we expect stocks to return this amount. In fact, years where inflation was the lowest also showed that sometimes that was the lowest performing year for stocks. And so there's not really a correlation between inflation rates and stock returns. But when you look over the long period, if you go back in history and you look at how stocks have performed relative to inflation, it's about a 7% difference. And so if you were to be invested in stocks, you'd see a 7% after inflation adjusted return on average. And so it's really one of the best ways to combat inflation is to have a portfolio that has exposure to stocks. Nathan mentioned these earlier. He mentioned TIPS, which are treasury inflated bonds, and they will also help in a situation like this where we have higher than expected inflation. TIPS can be a good hedge against that inflation in your portfolio. And that last little chart, you can see, even in a period of really high inflation like we saw in the first half of 2021, stocks still outperformed that inflation, and there was a positive inflation adjusted return for stocks and portfolios.
Yeah, and just another way to think about this, let's say you're Coca-Cola and you're dealing with high inflation and you're selling, I don't know how many sodas Coca-Cola sells in a day, but it's a lot. And what would you do? You're going to just raise the price of Coca-Cola, quarter, maybe you raise it 50 cents, and people are still going to buy the same amount of those. And so you can really, as a business, what happens during inflation, with inflation is prices go up and profits stay the same, and businesses figure out how to earn profits with high inflation, during low inflation, during all types of things going on in the world. And so inflation is a concern, but the best approach to fight it is to not keep your money in the bank, number one, but to have a well thought out, diversified portfolio that can weather these periods of high inflation. And what will likely happen with inflation, the Federal Reserve is going to raise rates, and that's one of their tools that can be used to lower inflation or to slow it down. We've actually been, over the past 20 years, probably 30 years, we've been in a deflationary environment. And there's a lot of reasons for that, but the most, I think, the biggest impact is globalization. As technology improves and globalization, businesses become more global, there's actually some deflationary pressures going on. And this higher inflation we'll probably be dealing with it for some time, but I don't know that it's going to be forever. And the market actually prices this out in the U.S. Treasury yields. And with a 10-year Treasury yield under 2%, the market's not expecting prolonged higher inflation. So we don't know, but the goal here, the takeaway is think about your portfolio and match it up with your goals, and that will deal with any inflation that we might experience.
Yeah, that's great, Nathan. I appreciate that Coca-Cola example. If you look at the last 30 years in this chart, 23 of the past 30 years saw positive returns after inflation, after adjusting for inflation. And so I hope the message here is that despite all the things we're seeing with COVID and inflation and all the concerns we have, the market is an optimistic market, and it performs even in spite of some of these negative things that we see. And so we are optimistic about how things are going to be and going forward over the next 5, 10, 15, 20 years. We're optimistic that the markets are going to continue to grow, that businesses are going to continue to find ways to succeed and innovate and bring positive returns for their owners. That's essentially what we are. We're owners of businesses when we invest in their companies. So unless you have anything more to add, Nathan, we have time for some Q&A. Whitney's monitoring those chats, so if you have a question, you can type that into the chat, and we're happy to answer any question you have, and we'll open that up, and we can do that for as long as there are questions. If there are none, then we can just end here.
No questions posted yet, but we'll give you guys a couple minutes to submit those.
So while questions are coming in, I'll talk about one other thing that we're hearing a lot right now, which is cryptocurrency and Bitcoin, especially. We get that question a lot, like should we be considering Bitcoin? Should we be considering cryptocurrency in our portfolio? And our advice is typically proceed with caution. Cryptocurrency is extremely volatile. Bitcoin's down 8% just this year. And it's not unusual to see Bitcoin gain or lose 40% in value in a month or two. And so because of those significant price swings, it makes it an unreliable medium of exchange, like to replace cash. So this idea that it's going to be a currency replacement, those large swings make it not a reliable replacement for cash right now. It's also makes it not a very great risk reducing investment for like bonds are, which usually temper a portfolio because of its significant volatility and its swings. It doesn't really replace bonds in a portfolio very well. It kind of appeals to the more adventurous investor, it's kind of like catnip for traders. It's really exciting and tasty, but right now, given its very relative short-term existence and its big price swings, we typically recommend not making it a big portion of a portfolio, if at all. Some people want to dabble in it and play around with it, which is, fine, have some hobby investment, but it doesn't really make up a really a good reason to have in your portfolio right now at this point.
And I would relate it more to gambling. The way to earn money on that is pure speculation. If the prices go up, you're gonna win. If the prices go down, you're gonna lose. To me, it's no different than taking your dollars down to Vegas and playing them on the roulette table.
Yeah.
So that's how, if you're going to do it, it's purely entertainment. It's not an investment right now.
Yeah, I agree with that. And I think one thing it's important to recognize too in investing is it's a zero-sum game. For every individual who gets in and out of a crypto at the right time, there's someone that got in and out at the wrong time. There's two sides to a trade. And so it's important to recognize that oftentimes we see in the media people that are having wild success because we like to report our successes, but people are not reporting their failures nearly as often. And so we're not getting a totally clear idea of what's happening with investors in some of these things.
Yeah.
Any questions
about it? The best thing about it is probably the technology, which will have some potential uses down the road. But it looks like there's a question. I'll read it here. Do you have concerns about aging populations withdrawing money from the market, more money than is being put in? So good question. We definitely have an issue with an aging population, and the birth rates are not, they're actually going down. I just saw that Utah's birth rate is now down to 2.1 per couple. And we're not the highest birth rate state anymore. It's actually the Dakotas now. So that is a concern. But as far as the market goes, if you think about what happens when somebody takes those dollars out of the market, say a retired person takes money out of the market, what do they do with those dollars? They go and buy goods and services, which keep the economy churning. And so there's not a real concern that it's going to affect stock prices or the way the market works. The bigger concern is probably how does the government deal with Social Security and other retirement programs, Medicare, for example, because if we don't have enough workers, as the population ages and people live longer, then there's not enough workers to replace them to pay into the Social Security system and the Medicare system, we will need to figure out ways to deal with that. And Congress is notorious for putting things off. I would love to see them make changes now, but they'll likely push it off till 2032, which is when the trust fund and Social Security runs out. So we are going to be doing a webinar on Social Security in a few weeks, so watch for that and tune in. But good question.
Okay, well, I'm not seeing any other questions, Nathan. I think we've given the people the time they need to ask their questions. If you do have more questions down the road, likely you received an invite from one of your friends or acquaintances who's an advisor at Squire or Squire Wealth Advisors. Feel free to reach out to them, or you can connect with me and Nathan. We're happy to answer any questions and see how we can help. But I think that's it for now. Appreciate all those who attended. Appreciate you taking the time to listen to us ramble on about this nerdy market stuff that we love to talk about. And yeah, I don't have anything else.
Have
to
a
add
great
to that.
2022. We look forward to meeting with you individually. See you later.